Okay, so this next problem we're going to look at is number 30, and I'm going to tell you guys to buckle up and hold on because this is where it starts to get really interesting. Um, this problem number 30 is having you write out the B entry, B for bonds. I mentioned it during the lecture, but that's the consolidation entry that they're asking you to do here. And again, it's not, each individual piece is not that hard. I think it's just when you put it all together, it gets a little crazy. Um, but if you look at the problem, it says that several years ago, Brandt sold $900,000 in bonds to the public. The interest rate, the stated interest rate is 9%, but the bonds were issued at a market rate of 12%. So they were issued actually at a discount. Now, at the beginning of 2016, you'll see there that Zach Corporation, that happens to be a subsidiary of Brandt, they bought a portion of those bonds on the open market. Now, and they paid 201 for the bonds. That's an effective interest rate of 7%. Now, here's the thing. The debt is going to remain on Brandt's books. And as far as Zach Corporation is concerned, they're still going to have an investment in bonds that's on their books. But when you put the two companies together, right, when you consolidate the two companies, that portion of the debt that Zach Corporation has bought is effectively retired, right? And so that's going to have to be eliminated when we do the consolidation. That's what that B entry is for. So if you look over on the right-hand side, you look at the solution, there's actually 5 pieces that we have to figure out to do the B entry. The first part we'll look at is the gain or the loss on the retirement of the debt, right? And we've had that before. So either, whoever bought the debt, either we effectively had a gain on the retirement of the debt or a loss. In this case, we have a loss. So if you look at the information that's given, it shows here that Zach bought the bonds. Okay, they paid 201, right? And the difference between that and the carrying value, that's the loss. So the carrying amount is the 760, right? It says that on that date, the bond liability had a carrying amount of 760. Zach bought a fifth. Right? They bought a fifth of the bonds. If you take 180 and divide by 900,000, that's the 1/5. So they bought a fifth of the bonds. So that's where I'm getting the carrying amount there of 152. Right? They paid 201. So they essentially spent $49,000 to retire the debt, 49,000 extra, and that's why we treat that as a loss. Okay, so that's the first part. That's part one. That's the loss. In this case, it's a loss. So that portion of the debt that Zach bought, that is from a consolidated perspective, is effectively retired. We did record a loss, or we will record a loss to retire that portion of the debt. So that's the first part. The second part of this, second and third parts, is to figure out what the interest income is and the interest expense that needs to be eliminated. Now, the interest income, that would be reported on Zach's books, but again, from a consolidated perspective, it has to be eliminated. And the interest expense is the same way. That's on Brandt's books, but again, from a consolidated perspective, that has to go away. So here's what we're going to do. The 201, that is the market or the initial carrying amount of the investment on Zach's books. And for the year, they're going to report 7%. That's the effective interest rate. That's how much interest income they're going to report. Now, that doesn't have anything to do necessarily with the interest they're actually going to receive. We'll talk about that next. We're just talking about the interest income. Okay, that's based on this effective interest method that we've been using since Intermediate 2. And we take the carrying amount of the investment, 201 times 7%. So that's the interest income that has to be eliminated. The interest expense works the same way. You'll notice that the carrying amount of the debt up there, the 152, that's how we got that earlier when we calculate the loss. We're going to take that times 12%. That's the effective rate for the bonds from Brandt's perspective. And so that's the interest expense that they have. Okay, let's keep going. All right, so the other two pieces that we have to take care of, we have to figure out what the investment in bonds looks like at December 31st, 2016. That's the end of the first year. This is after the debt has been bought, right? It says at the beginning of 2016. We're at the end of 2016 and figuring out what that investment account looks like. We also have to figure out what the bonds payable balance is, and that's going to be on Brandt's books. Okay, so let's look at the investment first. Now we know the original cost of the investment, $201. That's how much Zach paid to buy those bonds. Okay, we do have to amortize any premium or discount, and in this case we have a premium, right? They paid $201 for those bonds. Okay. The amount of interest that they are receiving every year is based on the 9%, and that's 180 times 9%. So that's how much cash they're actually receiving. Okay. The effective interest income, we already calculated that above. That's what they're going to report on their income statement, $14,070. So that means that they are amortizing a portion of that premium. Right. The difference between those two numbers, that's how much they're amortizing of the premium. That's $2,130. And so what that should do is that should cause that initial carrying value of the investment, the 201, you should see it start to fall, right? It should be getting closer to what the historical, I guess, or the original cost of the loans would have been, which is 180. So it should be getting closer and closer and closer to 180. So every time we do this entry where we record the interest income, and then amortize the premium, the carrying amount of the investment should be getting smaller. It should be getting closer and closer to 180. And you can see that it is, right? It's now down to 198,870. So that's the investment balance that has to be removed as part of the consolidation. Okay. Now, the bonds payable, we have to kind of work it the same way, all right? The carrying amount, if you look up above, that was the 152 that we talked about, okay? That is, again, that 152, we have to take and figure out what the amortization of the discount is. Now, in this case, from Brandt's perspective, they're dealing with a discount. So here's how much interest they're paying, right? Notice that it matches up here, right? It should be the same number. But the effective interest expense is based on their market rate, which is 12%, 18,240 right here, okay? Again, the difference between these two numbers is the amount of amortization. Okay. Now, in the discount scenario, notice what it's doing. Notice it's getting bigger. Okay. Again, this 152, this carrying amount, has to be getting closer to the 180, right? Just like it is up here. So, with the investment perspective, the 201 needs to be getting closer to 180, and then from the liability perspective, the 152 needs to be getting close to 180. So that's how that works as far as the amortization goes. All right, so those are our 5 pieces. We've got to eliminate our bonds payable, and so the 154, that's going to be debited. Okay. The interest income that's been reported, that we have to debit that to eliminate that. Okay. The loss on retirement, that's what we figured out earlier. Okay. The investment account, that's a credit. And the interest expense, that's going to need to be a credit as well. Okay? And so what that's going to do, that's going to eliminate the intra-entity debt holdings, right? It's going to eliminate the interest income that Zach reported. It's going to eliminate their investment balance. It's going to eliminate the bonds payable on Brandt's books, at least the portion of the debt that was retired. Okay? And it's going to eliminate the interest income or the interest expense on that debt. And then finally, the loss that was recorded as a result of retiring that portion of the debt, that needs to be recognized too. Okay, so that's our B entry as of the end of. Let me get rid of this. Sorry, guys. That's our B entry as of the end of 2016. Okay, now I'm going to stop here and start a new video, and we're going to look at Part B.